Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we did the 100th episode extravaganza. So on the overtime, we're going to look at a trade that we did a couple of weeks ago in NUE Steel, and we're going to decide, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. All right, so on Tuesday's show, my colleague Lindsay Bell joined me, and we had a great 100th episode extravaganza. We talked about the most popular episodes out of the 100, and we discussed my favorite trade that we looked at, and also Lindsay's favorite episode that she partaked in. And today, because of that, I've been following along with the NUE Steel trade that we did on February 22nd in the Stock Play of the Day. That was a Tuesday show. We then did the overtime on the 25th, and we talked about actually setting up a fig leaf on that day. So inside the options playbook, I'm highlighting the fig leaf right now. And if you look at that, what that means is that we bought a deep in the money call option that went all the way out to July 15th. And that call option was a surrogate for owning the stock. So we bought something that was very close to an 80 delta. And as opposed to buying 100 shares of NUE Steel, we decided we're going to buy that call option and i.e. kind of rent the stock. Well, then we came back on the overtime and we looked at, well, the stock was up, so maybe we want to sell a call against the position, depending on, what you really wanted the underlying stock to do for you. But the stock was up, so that opportunity was there to try to sell a call at a higher strike. Well, this week, we did not do a trade, but I decided, well, let's talk about rolling a covered call. So I went back and looked at the NUE Steel stock, and we'll see that we're actually fairly close to the strike price that we chose on the overtime show. And I think that's a great opportunity to go out and talk about just rolling that option contract, because we haven't really had that opportunity on any of the overtimes to look at actually rolling a covered call position. So we're going to take advantage of that today. And I'm going to highlight here inside the options playbook, there's a section called managing your positions. And I'm pointing to it right now with my cursor. If I click on that, inside managing positions, we have rolling a covered call. So a lot of the themes of this section in managing your positions are going to apply to what we're going to talk about today. So let's go back and look at the chart on NUE Steel so you have a feel for what has happened going all the way back to February 22nd. So this line, we have a 3-month chart, and this is a daily chart. This line I actually didn't even adjust. That was still from the overtime episode that we did on Friday, February 25th, where we actually talked about this is what has happened with the stock. So on Tuesday's show, on the 22nd, NUE Steel was trading right around 122.70. The stock obviously had a down day and then a flat day and then a real strong day on Friday. On that Friday, the stock went basically over that week from 122.70 to 128.20. So 122.70 to 128.20. The stock was up $7.30 on the day that we looked at selling a call against our long option position and turning this position into the strategy inside the playbook that we call the fig leaf. Well, you've seen what's happened since then. Stock has ran all the way up and actually touched the 140 level and now is back down right around, well, right now it just dropped off a little bit. It's at 136.82. The call option that we looked at was selling the March 11th 140 call option. So we're right there. And inside the section of the playbook that talks about rolling your positions, we always say that if it gets to the strike price, that's when you want to think about rolling. Now, obviously, we always tape on noon on Fridays, so we can't control where the market's at. But this would not be a bad time to roll that position because we do want to avoid assignment. We have 7 days left until that expiration date, March 11th. So we want to roll and get ahead of the game because the one thing we don't want to happen on a fig leaf position is we don't want to be assigned on that short call. We're just trying to bring in some premium, but we sold it way out of the money in hopes that it would expire worthless. But the stock has made a very strong run up towards that strike. So the day that I would have tried to roll it would have been this day when it touched 140. And if you see here, the high end of the day, I think it was exactly 140 almost. And it ended up, I'm going to look at the close, the low, open. Let me see the close 1 second here. I got to move something. The close on that day was 137.53. Okay. So here's what we're going to do. Now hang with me because this is a 3-part stock play of the day overtime. We're going to talk about where we put the initial covered call or the initial long call on, the deep in the money long call. We're going to look at what option contract we would have sold against it, or we discussed a possibility of selling. And then we're going to talk about rolling that position. So it's going to be a little bit of an extended stock play of the day over time. So let's get into the Ally Invest option chains. So we see Nucor Steel right now is at 136.61. It's down 92 cents on the day. And I'm going to scroll all the way down to the bottom of the chains that I have set up. I'm going to show you the option contract that we bought. Okay. So to start with, we looked at the July 15th expiration. We were buying the 105 strike call. So I'll just click buy and I'll put that in there. We'll eventually remove that. But when we purchased that call, it was trading right around 24.30. All right. That's where the call option was at. Now, we came back on the 25th on the stock play of the day overtime, and we looked at selling the March 11th expiration, and I had to go all the way up to get to that expiration, 140 strike call option. Now, the market was a little bit wide, and that has to do with just the volatility of the marketplace overall. But we were hoping to sell that for, we guessed a midpoint price would maybe be right around 90 cents. So then we went and sold this option contract. And if you did both of those steps, which, by the way, none of this is meant to be a recommendation, right? We're just trying to learn here on the stock play of the day overtime. And if you did that, and we scroll back down to our workbench inside our option chains, this is the position that you would have had on. You would have been long the 105 call, short the 140 call. The market is now it came up and touched the 140 level, came very close to it. And I would have considered rolling at that point in time, but now it's came back a little bit, and we're still going to consider rolling that position. Okay, so how do we roll that position? Well, first off, we're going to remove this one because it doesn't have anything to do with the trade. That is just our long call option, our surrogate for the stock, if you will. The position that we're worried about now is being assigned on the 140 strike call. So we're going to do what's called a roll up and out. So we're going to go up in strike on the call option, and we're going to go out in time. And our goal when we roll up and out is to get it done for even, at least be able to get it done for close to zero or a small net credit to the account. And we can do that at this point in time. And here's the reason why. Because the stock hasn't gone through the strike price. If that option contract that we sold gets too deep in the money, it's very hard to roll up and out and get it done for a decent net credit to the account. By going up and out, we're going to say, okay, the stock's got to continue on up, continue this bull run. And it has to do that in the short term. We're going to add another week onto this trade. So let's go back and look at the trade. Okay, so here's the position that we had. We were short that option contract if we had that on inside our portfolio. So now we need to buy to close that position, to wipe it out, make it no longer. So how would we do that? We'd click this little inside the Ally Invest option chains, obviously. We'd click buy, and then we'd go to the strike that we want to sell. So we're short the 140. I went and looked before we started our video today, and I looked at the 145. So the 145 is trading $3 by 320. The 144 is 320 by 350. And let me go back and see what we're purchasing. Okay, 286 by 315. So once again, I would consider the 144, but I really don't want to be assigned. So I would bring in a bigger credit, obviously, if I rolled to the 144 strike. And notice we're only going out another week to the March 18th expiration. But I'm going to give up some of that credit and just go a little bit further out of the money. And I would personally choose the 145 strike because I'm a little bit nervous about being assigned by adding another week of time on. Okay. So I'm going to go down. And the trade that we then would have is we would sell, I went too far, the 145 strike, which is 305 by 330. And so let me click on that, and we click sell. And so in our workbench, we then have the rolling trade. We would be buying to close the March 11th 140 strike call, and at the same time selling to open the March 18th 145 strike call. And right now we can get it done for about even, not much of a credit to the account. Now notice this says debit, so that means that on the bid, if you've got the worst case scenario, you would be paying a net debit to roll this trade of 30 cents. On the ask, if we were, because we're selling this, if we did the best that we could in the marketplace based off of the bid and ask, we would bring in a 31-cent credit. So in this instance, we're just going to break even on the trade. Hopefully, just flat. We'd have to pay commissions. So I'd hit the trade button, put it over here, and I have to make one last adjustment to this, and that I'm just doing it from the chains. I'm not coming from the positions page if I had the position on. And this says buy to open, but this needs to be a buy to close. The vernacular is important. If you were short that option contract, you sold it to open, now you have to buy to close. This would still stay the same as a sell to open. I would go in here and I would actually put even on this, and even means zero. That means we didn't pay a debit, we didn't pay a credit, we got it done for even. And that's the vernacular that the trading floor, or wherever you're sending the trade, not every place has a floor anymore, the cyberspace, if you will. That's the vernacular that they want. They want to say that this is done for an even, neither a credit or a debit to the account. All right, so we would be buying to close one of the March 11th 140 strike call, selling to open one of the March 18th 145 strike call. We're going to do this for even, and we put it in for the day, and we let the order ride. That's it for this episode of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and we'll see you this Tuesday for the next Stock Play of the Day. Thanks for coming, everyone.